Dividends are very, very misunderstood, but in this video, I'm gonna start from the beginning. I'm gonna explain to you what dividends are, how they're paid out, and we're gonna advance more into why I believe they're so misunderstood. Now, I'm gonna bring up Twitter a lot. I am active on Twitter. This is my account. Follow me there. I've only been a member for 14 or 15 months, and I'm very, very active. 1,430 tweets in that time. Guys, I like to engage people. I like to talk about people, to talk to people about their ideas. It's a very fun area. I love Twitter. I hate this new X idea. I don't even get this, but either way, follow me on Twitter and engage me. As long as you have a reasonable, great comment that I see, I will engage back. So, what is a dividend? Very simply, a dividend is the money paid out from a company to its shareholders. Very simple, right? Now, dividends are paid. There's a thing called a dividend payout ratio where they'll compare the dividends paid from a company to its earnings. So, for example, if a company makes $1 million a year and they pay out $200,000 in dividends, what's that ratio? It's 200,000 divided by 1 million, or 20%. Now, if you've watched our channel, you realize that I don't look at net income as the be all and end all because there's so many SEC and accounting rules and all these things that can change over time. I look at free cash flow. And free cash flow is cash from operations less your capital expenditures. Okay, so it's the cash generated by the business less the money they put back into the fixed assets to keep the business growing and continuing on. That free cash flow and net income over long periods of time should be very similar. But there can be manipulations in the earnings and the net income that's a lot different than the free cash flow. So I like to look at it as what percentage of the free cash flow are they paying? Now, one thing about dividends that I've seen a lot on Twitter, and this gets back to Twitter, people love what they call dividend investing. And I always chuckle when I hear the term dividend investing. I get what they're doing. But I feel like so many people are just attached to how much money can I get for the company, as opposed to how much, one, can the company afford to pay me that money? And two, is it the right use of the cash flow? So before I said the free cash flow is cash from operations less your capital expenditures. And there are 5 things you can do with free cash flow. You can pay those dividends, you can pay down debt, you can buy back shares, you can invest in yourself as a company, building more property, plant, equipment, et cetera, or you can make acquisitions. So paying out a dividend, to me, should be the last resort. But a lot of times, companies will pay a dividend for one reason and one reason only. They want to attract investors, right? Because they realize how much people love seeing that check. They think it's free money. But remember, it's not really free money, and here's why. Let's pull up a company here that pays a dividend. I'm just going to pull up Microsoft because it's very clean, but it's not a big dividend. The dividends they pay last year was $19.4 billion. However, you've got to remember that their free cash flow last year, $57 billion, was after taxes. They've already paid taxes on all the money they earned along the way, and then they had their net income and free cash flow. So when they pay out this dividend of 19.38, they've already paid taxes on the money to be able to pay that. And then when it comes to you, guess what happens? You pay another income tax. Yes, it's a lower rate, but when I hear people say, oh, it's not fair that the dividends are only taxed at a certain amount, I sit there and say, but it's already been taxed once before. If you own a business at home, you're not double taxed. If you own an LLC, if your company makes $1 million or $100,000, that's the one, you're paying it based on your personal income. It goes right to your personal income, and you don't pay a business income tax as well as a personal. But here, you're paying a corporate tax, and then when the dividends are paid out to the owners of the company, the shareholders, you're paying a tax again. So it's a double taxation, which first off, I don't like. But two, I want to make sure that if the company is really cheap, that they're buying back shares instead of paying a dividend. Why? Because as an investor for you, you want to get a bigger piece of the company. So if a company has 10 shares outstanding and you own one, you own 10% of the business. Instead of paying that dividend, if they went instead and bought back 2 shares over the next few years, now you still own your 1 share, but instead of splitting everything by 10 shares, it's now split by 8 because you bought back those 2 shares. You now own 1 out of 8 shares, which is 12.5 12.5% of the business. That is a big jump in your ownership. You increase your ownership by 25%, going from 10% to 12.5%. That's a much better use of your capital. As long as the shares are cheap, that's the big key. That's the big key. If the company has crazy expensive debt, I'd rather have the dividends go pay down that debt, because debt hurts the company if things get tough. Just like you at home. If you and your neighbor are exactly the same people, but you have same job, same house, same everything, same income, but you have zero debt, your neighbor has $10 million in debt, who's going to last longer if things go bad? You will, of course. And the other thing is people say, well, Paul, you don't get it. At least when I get a dividend, the money's in my pocket. I get that. It feels good to have. And by the way, guys, I want everybody to understand, I like dividends. I like getting them only if it's the last resort out there. Because at the end of the day, when the dividend gets paid, it gets paid out of the company's bank account. As a shareholder, you have access to that bank account. So you still have a claim on those dollars in there. But all you want to do is sit there and say, no, instead of those dollars in the bank account, I want them in my pocket and I'm okay paying a tax on it. Why? If the company can reinvest and get a high rate of return on that investment, wouldn't you rather have them do that and grow their net income and their cash flow until they have no other use of the funds, until they can pay you a much, much higher dividend? But of course, everybody looks at dividend as essentially free money. It is not free money. If the dollar is in this pocket or in this pocket, you still have that claim there. But I get it. The money's sitting in a company somewhere. And guess what? A lot of corporations are really, really dumb with their investing. And you would want them to give the money out as dividends, 100%. But that's after exhausting all options, most importantly, of buying back shares. Buying back shares will do a much better job for investors, even if your company is just meandering along. You can still buy back shares and drive up the share price. And here's how. Let's say you have a company that's not growing at all, and it's going to make that $10 a year for the rest of the time. And it has 10 shares outstanding. That's $1 per year. And let's say the company is kind of looked at poorly, so it sells for 12 times $1, a 12 PE. Each share is $12. Now, let's say over the next 20 years, instead of paying a dividend, they buy back a ton of shares. They still make $10 as a company. But instead, they've bought back 6 shares. So now they're down to 4 shares outstanding. Now, every share gets $2.50 per share in earnings versus $1. Assign the same 12 times cash flow, and now you're at a $30 share price. You went from $12 to $30 in share price, even though the income stayed exactly the same. That's how buying back shares is very important. But again, it must be done on cheap companies, low multiple of earnings and free cash flow. That's what's most important. But I truly, truly view paying a dividend as a last resort. The last thing you want is a company that can grow a lot to be wasting its capital paying out dividends. You watch Shark Tank. They'll always sit there and say, what your company needs to do is reinvest, not pay out owners. They'll say that all the time. If you have a lot of growth potential, you want to keep the money in the business and grow that revenue and profit over and over and over and only pay a tax on it one time through the corporate level. Keep driving that up. Because if you can grow profit at 10, 15, 20% a year, why would you ever pay that dividend? Especially if it's 15 or 20%. Because now you're going to give the money to you as an investor. You're going to pay a 30% tax, and you're probably not going to be able to get that 15 or 20% return. So why in God's name would you do it? So that's very, very important, guys. So if you like what I'm saying, and this is eye-opening for you, I ask you to do a couple things. 1, subscribe to the channel, like this video. And 2, share this with somebody else who might not really understand the dividends. I'm going to post this on Twitter when this comes out because it's really, really important to me that people understand that dividends are a wonderful part in investing, but they shouldn't be the go-to at all times. Don't be that person who just looks at a dividend and thinks it's awesome. Thank you very much for your time.